Begin at the first chapter of financial market and products. This chapter builds the foundation of the entire FRM syllabus. So let's start with the basics. Banks perform two major functions: commercial banks and investment banks. Commercial banks take deposits and give loans. Investment banks helps companies raise capital. But whether a bank is lending or trading, everything leads to one single thing: risk. Banks face three major risks: credit risk, market risk, and operation risk. And each of these risks has shaped global finance. Let's start with credit risk. Credit risk simple means the borrower may not repay. The biggest proof is that the 2008 subprime crisis. Bank gave home loan to borrowers with a weak credit. Millions default, global bank collapse. That's how dangerous credit risk can be. And this isn't just global. India saw the same pattern in the Yes Bank crisis. Loans were given to stress companies like Jet Airways, DHFL, IL&FS. When they default, Yes Bank collapse under credit risk. But even the borrowers repay, banks still face market risk. This risk comes from price movement. The most famous example, JPMorgan London fail. One trade placed a massive derivative bet. The market moves in a positive direction. The bank lost 6.2 billion. One price movement, one wrong position, and billions can vanish. And even if credit and market are under control, banks can still collapse due to operation risk. This comes from failure in system, people, or process. A perfect example is Night Capital. One software glitch, wrong order, and 440 million lost in just 45 minutes. In India, HDFC Bank faced RBI restriction because of repeated digital banking outage. Again, pure operation risk. To protect bank from these risk, Basel introduced capital rule. Bank must maintain regulatory capital, the minimum required by Basel. They also calculate economic capital based on their own internal models. But after 2008, Basel realized something: capital alone is not enough. So they introduced LCR and NSFR to ensure banks have liquidity during stress. Now, banks have deposits, and government offered deposit insurance to build customer confidence. But it also create moral hazard. When depositors know their money is insured, they stop checking whether the bank is risky. This allow bank to take one even more risk. In investment banking, securities can be issued through private placement, best efforts offering firm commitments, or Dutch auction. But when a bank does both commercial or investment banking, conflict of interest arise. To prevent misuse of confidential information, bank must maintain strong Chinese wall. Banks also divide assets into two books: the banking books, where loans and held are held to maturity, and the trading book, where assets are traded daily and marked to market. Finally, many banks followed the originate to distribute model. They create loans and sell them to investors. This increase liquidity but can also weak lending standards. So overall, this chapter explains how bank works, what risk they face, and how global regulations try to keep the financial system safe. Thank you.